Hello everyone and welcome to the YouTube channel of BeingACCA. This is Tushita Gupta, ACCA affiliate, and we are continuing with our chapter-wise revision. So this is chapter number 13 right in front of you, which is the capital asset pricing model. So, in this chapter, you're learning how the pricing of securities works, how you can calculate a risk-adjusted weighted average cost of capital. So without any further ado, let's get started. So basically, according to what this model is, your total risk can be divided into two types of risks. So the total risk that a company faces can virtually be divided into two types of risks. The first is a systematic risk, and second is unsystematic risk. Now let's understand what do these risks mean. So basically, when I say unsystematic risk, it can also be called, another name is unique risk, and another name is diversifiable risk. So basically what this means is that this is the risk which is, unique to each company's shares. So let's suppose because of the seasonal nature of my business, my sales peak in 1 or 2 months, and for the rest of the years, perhaps maybe I make ice creams. So during the summers, obviously I make a lot of sales and I make a lot of profits, but during the winters, ice cream sales go very down if you compare it to the summers. So this is why this risk is specific to the shares of that company because of the nature of the business that they do, because of the industry in which they operate. Hence this is what you call unsystematic risk, this is unique risk, and this is diversifiable risk. Now what do you mean by diversifiable is that when I am an investor and I have a huge portfolio of stocks, so I will divide this into multiple companies. The money, let's suppose I have $100,000 with me in my hand today. So I will invest these $100,000 in different industries. Maybe I can invest something in the cement industry, maybe something in the FMCG. FMCG means fast mover consumer goods. So something in the FMCG industry, something perhaps in the airline industry, something maybe in the tourism industry. So this is how my entire investment gets diversified into different sectors. Even if one sector is hit, the other sectors are going to compensate for the returns. Otherwise, if I just invest in one sector and it goes down, then my entire investment value goes down. So that's why unsystematic risk is also called diversifiable risk, because once you have a diversified portfolio, this kind of risk, the unsystematic risk, gets reduced by a significant amount and almost becomes zero. Now, the second type of risk which we have to understand is the systematic risk, where we are this is also called as your market risk, and this is also called as what you can call an undiversifiable risk. Now, this risk is the risk which is there in the economy as a whole, something general which impacts everyone. So, let's take an example of inflation. So, even though inflation may affect some industry more, some industry less, but such factors will affect all of the industries in the economy as general. So, even if the coronavirus, if we talk about the COVID-19 that came up, so that also affected all of the industries. Some industries were hit very high because of this, were hit very hard because of this. You can take the example of airline industry, the tourism industry. So these were very, hard hit. But if you talk about the other industries, if you talk about some, pharmaceutical companies who were manufacturing all the vaccines, the medicines, and perhaps talk about the food companies. So basically, if you're supplying basic necessities, people are going to consume food no matter what. So this is how systematic or the undiversifiable or the market risk affects the market as a whole rather than any specific company. Hence these two names are also there. Now, to also understand this with the help of one more example, the diversification which I was talking about. So let's suppose, taking an example where copper, so copper is a metal, right? So let's suppose that the price of copper rises. Now, what happens is copper is one commodity which can be, uh, one is the company who can mine copper. So it's a mining company who mines copper. So now, because they go into the ground and they, dig out, they mine out copper. So this copper gets eventually sold into the market. So basically, what they are selling, the price of what they sell has increased. So that means more profits for them. So more profits for them means the share price of this company goes up. But at the same time, let's suppose I have also invested in a company who, uses the copper to make some probably utensils. So for a company who makes utensils, so for this company, basically copper is a raw material, because using this copper, they are making the products that they sell. So once the price of raw material has gone up, this will mean lesser profits for them, lesser profit margins from them, for them. So profits fall and hence the share price fall. So if you see, systematic risk, affects, the all of the economy, all of the companies in the economy as a whole. The effect can be positive or negative depending upon how they use that commodity. So this is the example that I wanted to give you. Now, we have already talked about how systematic risk can affect some company more and some company less. So when I talk about systematic risk, so basically, how do you measure how sensitive a company is to systematic risk? So this is measured through beta. So basically, this beta is a measure of, how sensitive a company is to the systematic risk which is there in the economy as a whole. So basically, it is, if you want to have a definition, it is an index of responsiveness of the returns of the company's shares, returns on company's shares compared to returns on the market, returns of the market as a whole. So basically, through beta, you're comparing how good or how bad a company has done compared to the average market return. So let's suppose the average market return has been 10% to the investors. Maybe if a company has given 12% return, so basically it is more sensitive. If the market grows by some proportion, it's going to grow by a higher proportion. Similarly, if the market falls, it's also going to fall by a higher proportion than the market. So this is what you mean by the beta. Now let's see how we interpret beta. So the interpretation goes like, there are three scenarios. Either your beta can be equal to 1. So if your beta is equals to 1, this means that the share is earning the same amount as the market. So it's neutral, it's not very risky, and it's not very conservative also. So that means if the market is giving you a 10% return, this share is also going to give you a 10% return. So it goes on, almost exactly the same as the market is going. Hence the beta is 1, because comparing company return with the market return, the ratio is 1, which means they are giving the same return. Now if I talk about a scenario where my beta is greater than 1, this means this is an aggressive, this is a risky company. Why? Because the return definitely is going to be more than the market. But if the market loses, if the market falls down, again, the loss is also going to be higher than the market. This is why it is considered to be risky and a more aggressive company. Now, the third option, it can be that your beta is less than 1. Now, if your beta is less than 1, this is a rather defensive company. So this is less sensitive than the market. If the market is falling by, let's suppose, 10%, that stock will only go down 8%. So it is less sensitive than the entire market as a whole. Hence, it is considered defensive. Even when the people have lost, maybe they had invested 100 rupees, their 100 rupees have now become 90. But if you had invested 100 in this stock, you're still going to have 92. So you're still in a better of position because of investing in a defensive stock. So this is how you interpret beta. This is how the interpretation of beta works. Now, the formula, basically the CAPM model, the capital asset pricing model, gives you a formula to calculate the cost of equity. So the formula given by this model is that ERI equals to the risk-free return plus the market risk premium multiplied by the beta. So let me write what all of these symbols signify. So ERI is nothing but the expected or the required rate of return. Then RF, as I already told, is your risk-free rate. So basically, what is risk-free rate? Perhaps, the rate of interest which is offered by the government securities or maybe on the fixed deposits. So this is what a risk-free rate is. And then if you talk about the ERM, basically this is the expected return which the market is giving. Expected return on market portfolio. This means a portfolio which is well diversified. It has, you're not placing all of your eggs in one basket. You're investing in stocks which pertain to different industries. So you subtract from this the risk-free rate. So this gives you the premium that you get because of investing in a risky investment. Risk-free you're getting without any risk also, but because you're investing in the market, so how much extra over and above the risk-free rate is what you're getting is your market risk premium. And like I told you, BI is nothing but the beta. So this is the formula that has been given by the CAPM model. Now, usually it is said that, the companies should not aim to diversify their operations or should not, diversify their operations. Rather, shareholders should diversify their shareholdings. Now, why is it said that? Is it said so? Because, uh, for me as a shareholder, it's very easy that I go out in the market, buy one share of, let's suppose, ITC, which is operating in, primarily the tobacco or the FMCG industry. Then if I talk about, if I want to invest in some other industry, maybe I buy Ambuja cement so that I enter into the cement industry. Maybe I buy some shares of Hindustan Oil Exploration. So with this, I invest into the oil industry. So I keep investing shares into different kind of industries. This is very easy for me because I can just go out in the market and purchase these shares. But think of it from the perspective of a company. A company is working in their own line of business, and they may or may not have the expertise to run a business which they can run in different industries, because they may not have the expertise. Maybe the company which we are talking about currently runs in the cement industry, and the shareholders want them to diversify to tourism industry. Now they know their cement industry very well, they're doing very well over there, but then when they try to venture into the tourism industry, because they are new to the industry, maybe they're not able to compete well with the competitors. So this is why a company should not diversify their operations. Rather, a shareholder should diversify their their portfolio. Now, when we talk about beta, again, there are two types of beta. The first type is your asset beta, and the second type is your equity beta. Now, the asset beta is that beta, think of a company which is ungeared. So if a company is ungeared, basically this means that they do not have any debt on them. They are all equity financed. So in this scenario, the business is facing no financial risk because they do not have any debt. So if a company does not have any financial risk, the only risk that they are facing is the business risk. So for any company who does not face any financial risk, only faces the business risk, the asset beta is what is going to tell you how risky a business is. And then if you talk about equity beta, talk about a geared company. A geared company is a company which has debt in their capital structure. So because they have debt, that means they have financial risk. And since the shareholders are taking an increased risk because their turn in the event of a liquidation comes later, even the profits that they get is after the interest has been deducted. So because they are taking now more risk, they want to have more return also. So more return to shareholders. So now this is what equity beta will give you. The impact will give you how risky a company is according to the business risk as well as the financial risk. So asset beta will only consist of business risk, but equity beta will give you both business as well as financial risk perspective. So if the equity beta, that means the business risk as well as the financial risk of the company is built into it. All right. Also, just to have a side note, if you talk about an ungeared company, its asset beta is going to be the same as equity beta because they do not have any financial risk. So the business risk, so basically asset beta is your business risk, and is your business risk, and your beta equity is nothing but your business risk plus the financial risk. So if this part becomes zero, so this gets cancelled, so these and these are equal. So this is what I am saying, that in an ungeared company, beta asset will be equal to beta equity. And now if we talk about a geared company, a company which has the presence of debt in their capital structure, for that company the beta equity is going to be a higher value than beta asset. Why? Because beta asset only consists of business risk, whereas beta equity consists of business risk plus the financial risk. So because something is extra over here, that is why this side is greater. All right. So what happens is, basically whenever a business is trying to venture into some new industry, perhaps let's understand with the example that I am running a business in the cement industry. I am ACC Cement. So if I am this company over here, I am trying to venture into the tourism industry. I'm continuing with the example which I've taken earlier. So I know my business of cements very well, but since I'm venturing into a very new industry which is unrelated to what I do not know how things work in this industry, but still I'm trying to venture. So obviously, the risk over here changes, because so basically we talked about two types of risks: the business risk and the financial risk. So because the industry as a whole is changing, it is this component which is going to get changed. My business risk gets changed. So because my business risk is changing, my equity beta will change over here. So because my equity beta will change, I will have to calculate a revised cost of equity, and then using that cost of equity, I will also calculate a risk adjusted weighted average cost of capital. Why will it be called risk adjusted? Because I have accounted for the increase or decrease in risk according to whichever industry is the new industry that I am venturing into. So let us see what formula we can use to establish a relationship between beta asset and beta equity. So the formula, this will also be given to you in the exam. Beta asset equals to value of equity divided by value of equity plus value of debt into 1 minus t, and this entire value is multiplied by beta equity. So this is the relationship which you have. In the exam formula, you will also see a value of debt over here. Sorry, beta of, the debt beta. But over here, we assume that to be 0. So that figure entirely becomes 0. So this is the formula that you have to use. Now, you have also learned the steps which you have to follow when you are finding a risk adjusted WACC. So let's just quickly go through those steps which we have. So step number 1 is going to be to find a suitable proxy company. So you find a proxy company. This means that since I'm trying to venture into the tourism industry, I'll find some company who's doing good in the tourism industry. So perhaps maybe Make My Trip. So Make My Trip is a good player in the tourism industry. So I will find a proxy. I will find someone who is doing good in that industry. Now, once I have found someone suitable, what I will do is I will find out how much is their equity beta, how much is their gearing level, how much debt and how much equity they have, and how much tax that they are paying, so the tax rate. Then the third step will be to use this formula over here, beta asset formula, to ungear the proxy beta, the proxy equity beta, to the asset beta. So if you convert the equity beta to the asset beta, basically asset beta gives you the business risk. This is what you want because you are venturing into the tourism industry. You do not want their financial risk because their capital structure is different. Your capital structure is different. You just want to know how much is their business risk. So the business risk will be given by their asset beta. So you find out their asset beta. Now you have found out how risky the business is as a whole. Now you will convert that into according to your financial risk. So then you will re-gear this equity beta, re-gear this asset beta to equity beta, to your company's capital structure. Right? So you will take their business risk and take your financial risk, and then you will re-gear the asset beta to find out the equity beta. All right. So now the last step over here will be, now that you have found out the beta, you will use the CAPM formula to calculate the cost of equity and then ultimately to calculate the WACC. So this is how the steps go. Now let's also discuss what the assumptions in this model are. So number 1 assumption is that your total risk is equal to the sum of systematic risk plus the unsystematic risk. So this is the total risk that is existing in the industry, in any company as a whole. So these two are the components of the total risk. The second assumption goes that unsystematic risk can be completely diversified. So because I'm holding investments in different industries, I have a diversified portfolio. So this risk can be completely diversified. So that means it becomes 0. There is no unsystematic risk that any investor is facing. The third assumption over here is that all companies' shareholders are holding well diversified portfolio, which is what we talked about over here also, well diversified portfolios. Now, one more assumption is that there's a perfect capital market which is existing and all the securities are correctly valued. So, perfect capital market. Then another assumption is that you are assuming a standardized period of holding, which means, because we cannot be comparing returns of 6 months to 1 year, so it is assumed that we are calculating returns over a year. So we are standardizing the holding period. Maybe some investors do not hold the shares for 1 year, they are selling in 1 month, 2 months, 6 months. So this is also one assumption which they are keeping in this model. And the last assumption over here is that the risk-free security exists, which provides a minimum level of required return to the investors. So risk-free security provides the required return to investors. Now we are coming close towards the end of this chapter. There are a few advantages and disadvantages that have been spoken about. So the advantages, basically, if we talk about, is number one being that it only talks about your systematic risk, because any rational person would think of diversifying their portfolio. So it concentrates only on the important risk, which is the systematic risk. So this is one advantage. Then another advantage is that this model, the CAPM model, has been a part of empirical testing and research. So this is, you can say, it is a good method which is backed by research, so you can use it in the real life because there has been research and testing done on this model. Another advantage is that it gives you a relationship between the required return and the systematic risk. So relationship between required return and systematic risk. One more advantage is that it is superior to using existing WACC. Obviously, because you're venturing into a different industry, so it is providing you the business risk of the industry where you are venturing. So it indeed is better, superior to your existing WACC. And the last but not the least is that it is a much better method of calculating the cost of equity rather than using the dividend valuation model. So again, you can say it's a much better method for KE rather than DVM model. All right, now this is what the advantages look like. Let's also discuss the disadvantages and then we wind up this chapter. So the disadvantages over here are, number one, that it's a single period model, which means we are assuming that it's only for 1 year. Then it's a single index model. One more disadvantage is that there may be a lack of data for the model. You may not have all of the sufficient information which you need for your calculations. Second last being that the assumptions which we have just studied above may not be true in real life. Then the last assumption that we have is that CAPM will tend to overstate the required rate of return on high risk companies, because the beta is high, so the required rate of return will be high, and it will understate the returns on low risky companies. So overstate on high risk and understate on low risk. So with this, we come towards the end of this chapter. I hope that this was useful, and I'll catch you for the next chapter.